Hello and welcome to our fourth quarter webinar for a 2024 market review. I'm Robert Clark, joined by Chris Ingram. We lead an RIA firm, Prosperitas Financial, and we like to record these webinars and put these together to share our investment thesis, the decisions that we're making along the way, so you have a little bit more context as to the things that we're looking at. And really, Chris, I mean, we just wrapped up the fourth quarter of 2024, which is kind of a mixed bag of emotions that we'll dive into. Let's just jump into our agenda. So what we're planning to share with all of you today is obviously our fourth quarter market review. And so we're going to look at all the major indices, their performance, not just over 2024, but for the fourth quarter as well. The current market trends that we're seeing, and then we're also going to look back at, hey, when have we seen these similar market trends and how did the market react through those time periods? We'll end it with highlighting our portfolio performance for Prosperitas Financial and the several portfolios that we manage on your behalf. And lastly, you're going to want to stay to the end. We're going to release our 2024 annual letter live in this webinar. So make sure you stick around to the end. And with that said, let's go ahead and dive right in. So what we're looking at is, again, fourth quarter results and 2024 results for the major indices that we pay attention to. So which are those? Those are the S&P 500, the NASDAQ Composite, the Dow Jones Industrial Average, and the Bloomberg Aggregate Bond Index. And really, we'll do a little bit more of a specific dive into those numbers, but from a high-level view, what we really saw in the fourth quarter specifically was a rally in growth in tech holdings. Reason being, the election was finalized. Trump was elected our next president of the United States, and investors really liked that for those large cap growth stocks. And where those funds came from, a lot of those came from the more conservative investments, those being the value holdings. A lot of the bond funds left and went into the market in those large cap growth stocks. And then obviously international just didn't have much of a 2024 in general. They did pick up a little bit in the third quarter, but back in the fourth quarter of 2024, we're back to underperforming the general market. Chris, I don't know if you want to run through any of the specific numbers there on the screen, but
yeah, I mean, a fabulous year across the board, I think. Fourth quarter, with the S&P up 2.4 and wrapping up the year over north of 25%. That's a great year in the market, and I will highlight 23 and 24 back-to-back really good years for the S&P 500. I don't think we've seen 2 years in a row with as good a performance going all the way back to the late 90s. So it is somewhat of a historic 2-year run in the S&P 500. NASDAQ had another great year. Tech stocks were up big again, up 29.57%, I believe that says. Dow Jones, that's your industrials, more value-oriented companies, still had a good year, but definitely lagged some of those growth stocks like Robert was talking about, up 14, just shy of 15%. And then the Bloomberg Ag is that bond index that we follow. And honestly, it was doing really well until the fourth quarter and just got hammered in the fourth quarter, down over 3%, and really found its way to just north of 1% for the year. So really not great numbers there when we were having a relatively good year up to that point in that bond index.
yeah, I mean, if you think about it, if the bonds just had a flat fourth quarter, they would have ended the year at almost 5%.
Yeah, and we dropped down to, it was a rough fourth quarter for sure.
Absolutely. And in a later part of the presentation, we're going to highlight how our portfolios at Prosperitas compare to each of their respective indices. So we'll get to that point, but at this stage, we really just want to highlight the general market and what we've seen. So one of the overarching themes of not just the fourth quarter, but 2024 is one of the things that our team is paying attention to is this valuation index produced by Morningstar. What this is really looking at is the median price of different holdings and how they compare between their specific sector and the size of that company. And so from a general view, what you're looking at that chart on the left is when it dips into the blue, that means the market is undervalued. And when it comes up in that orange area, that's where we start to see these overvaluations. So that initial large blue dip is obviously COVID-19 and the pandemic, where we saw that large sell-off of most of the market. And then we started to see that overvaluation period in 2021, which led to a pullback, and especially in the tech sector for 2022 and 2023, and only recently have we started to see this rebound. However, we're getting close, we're not quite there, but we're getting close to that overvaluation number. I think the number on that chart is really looking at a 10% overvaluation. And so, again, nothing that's a huge red flag, but we're paying attention to. And really, that graph on the left is a general overview of the entire market on one line. And so obviously there's a broad mix of different holdings, different asset classes, sectors, sizes of companies. And so the chart on the right helps us see, what's really driving this market valuation or overvaluation. That's where we start to see this is really coming from a lot of those large growth-oriented companies. A lot of tech companies fall into that category. And what's kind of being pulled along with it, so that undervalued sector, are going to be the small cap companies, and especially those small cap companies on the value side of things, not the growth companies. And so that just helps us see, we're constantly looking at, hey, how is how are the water levels balancing out, and where, if we're feeling overvalued in one sector, where might we go to find some undervalued, some discounted companies that might be smart to hold or shift towards in any one of our portfolios. Along with the rally in the growth and the tech stocks, when President Trump was elected, our next president, we saw a significant rise in cryptocurrencies and speculative assets. We're going to go through some more specific details here in a bit. But the ones that really shine brightly is Bitcoin was up over 40% since Trump was elected. So if we think that was just 2 to 3 months ago, and so a 40% growth in one asset like that is significant. And then we see our good friends, the NFTs, and you might not have heard NFTs for some time.
Been a little while. They faded, and now they're back.
Exactly, and I think the last time these were really kind of the hit craze was 2021, back when the market seemed to be overvalued. And so it's interesting that here we are again, approaching. Let's see, Pudgy Penguin is the number one leading market cap.
I was totally going to buy a Pudgy Penguin, but I realized that I didn't want to spend $516 million on a Pudgy Penguin.
Yeah.
NFT, not something I'm looking to buy, but it is pretty interesting when you see kind of the euphoria of speculative assets as a whole. You start to get these weird other areas of the market that really start to get drug along with it.
Mm-hmm. And so, as an investor, what do we do? And that's kind of the question that we want to dive into today. Of, do you ride the coattails of some of this euphoria? Do you capitalize on just this long run and almost continuing purchase and demand falling into these speculative assets and these larger tech companies, or do you make decisions that kind of go in the other way? Chris, I want you to highlight this one because you were very involved and very aware of the markets while this was happening.
Yeah, when I was in fifth grade, it's funny the things that you remember from your childhood, right? When I was in fifth grade, I went to Pinecrest and Thousand Oaks. If there's anyone else watching that went to Pinecrest and Thousand Oaks, my history teacher had across the top of the room in red paper, and back then, you're probably still too young for this, but the printer had like these little dots on the side that you had to feed in, and it rolled it out, and it was all like perforated, and he had this big long strip across the top, and it said, those who fail to learn the lessons of history are condemned to repeat them. And for some reason, it always stuck with me, and it's been kind of like a thing that I've carried with me along the way. And I think the importance of what we're going to talk about throughout this webinar is seeing that there's very much a cycle that these markets go through over and over and over again. And if you start to recognize them, you can start to really make wise decisions with your investments based on, having experienced them and recognizing which stage of the cycle you're in, right? If you fail to learn those lessons, they can be very, very painful. And that's where we're going to talk in these next couple of slides, is where things have gotten painful for people that didn't recognize the stage that we were in that current market cycle. And this later end of the cycle, you might call it, is this euphoric craze that comes in, where everybody thinks the market is going to continue to climb no matter what. Everything's going to be great. Every asset is good. And the more aggressive and more risky the asset is, the more they want to own it, right? This euphoria that sets in. And most that have been in the market for a long time will tell you it is actually a sign that we're getting to the end of that cycle, is this euphoric craze that starts to set in. And it happens time and time again. So let me backtrack. The reason Robert wants me to highlight this is, so I got in the business in the late 90s. I was a finance major at the University of Colorado. I was trading paper stocks in classes that I had at college. I was working for a financial advisor in the late 90s. And as I was trading, it was the advent of the internet, right? To some of you watching, there was a time period where the internet didn't exist. And as it became exciting, everything that was internet related was incredibly exciting. Nobody knew how we were going to even use the internet at that time. It was this kind of like the metaverse or these other things we talk about now, where you're like, what are we going to do in there? Nobody really knew how you were going to use the internet to make money or connect with people. It was all just kind of pie in the sky at that time. And so as people started to kind of figure out that the first phase was going to be commerce, everything that was a company that had a .com at the end of it, people got really excited about. .com being a domain name. And some of them didn't even have a website. They just had a domain name. And people were so excited about these companies that they were buying them hand over fist. And if you understand how stocks work, if people are buying them, the price is going to go up regardless of whether the company does anything, makes any money. If people are excited about it, they're going to drive that stock price up. And so you had these companies that had no profits, were not doing anything, didn't even really exist to some degree, that were jumping up considerably as far as their stock price just because people were buying the stock based on the euphoria that was going on. And as you can see from this slide, that I got into the business in '98 after I graduated from college, and for about 2 years that euphoria continued. Then about March of 2000, they call it the bubble burst, right? The tech bubble burst. Now, that continued for a very long time. We went into a recession, September 11th happened, all kinds of things happened during that time period. But you can see in this chart, the most important part to focus in on is that the NASDAQ, being a tech-heavy sector and just tech stocks in general and a lot of those speculative holdings, the NASDAQ went down almost 80% from top to bottom during that time period. And really, people will talk about it as it's this event in history, like the Depression, or like the Vietnam War, or World War II. Like, they talk about it, the dot-com bubble burst. They know about it. They understand that it was really, really painful. Unless you were there, I don't really know if you know how painful it actually was. It lasted almost 3 years. So it was a long, drawn-out, painful event that took place. But people talk about it, but I don't know that people really learn from it. So this is what it did. It was catastrophic. People lost a lot of money. And a lot of those little .coms, that you think that 80% drop is bad. A lot of those little .coms that didn't really exist, they went to zero. I mean, people lost everything on those investments during that time period. So a very rough time period to be in the market, but a valuable lesson to be learned when you see, what happens when that euphoria comes to the end and the tide turns the other direction. But that's not the only time it's happened. It continues to happen, and a lot of people continue not to learn the lessons from those time periods, unfortunately.
Yeah, absolutely. I mean, to your point, the NASDAQ is a diversified blend of tech-oriented companies, but for an index, that's like the S&P 500 having an 80% drawdown.
Massive.
It's significant.
Yeah, and again, a lot of those .com stocks aren't even in the Nasdaq. They're not big enough to be in the Nasdaq at that time, right? So this is the market. Those little speculative things, the stuff that didn't, much worse than that 80% drop in the Nasdaq for sure.
I wonder if there's any companies that are similar to this .com craze.
We might have
today.
A slide or two.
All right. Interesting. So another time this has happened in the markets, we pointed to the .com bubble. Obviously, the COVID-19 pandemic was a terrible event, a horrible event for our entire world. But there were some beneficiaries from a public company aspect, and those were companies that were helping facilitate business online and helping people stay fit and stay healthy and kind of move their gyms into their homes, right? And so two of those companies were Zoom Communications and Peloton Interactive. And not that either of these are terrible companies. These are phenomenal companies. And in COVID-19, you were smart to, think ahead of, hey, what's going to be our new world? And I think, Chris, you had even picked these up for our stock portfolio.
Yeah, we bought Peloton. Yeah, for sure.
Yeah, that's amazing. The thing is, at what point do you look at the diligence of, hey, wow, this has really gone up, and I think it's actually more expensive than what the value represents. And so that's exactly what we see here. When we look at what has happened to those COVID-19 darlings as far as stocks, and where they are today, you can see it has a large rip and a large upside, but it's almost unsustainable because investors are buying into the company for what the value is at that time immediately. But stocks, a lot of the time, you're purchasing a company based on the forecasted cash flow and analysis and intrinsic value. And so what you see is these stocks starting to decline and sell off. And why is that? It's because investors start to realize, hey, the value, the cash flow of this company doesn't support where we think it's going to be 5 and 10 years from now, and so you start to see investors leave some of these holdings.
Yeah, and the drops are significant once they realize that. We always say, understand what's a trade and what's an investment. Okay, so an investment is we hold a company in our portfolio. Let's use Apple for example. That, gosh, I hope we hold Apple for the rest of our lives. Great company, probably going nowhere, and unless something major changes, we might own it forever. Then there's a trade where you understand you're getting into something that has some kind of a run coming based on an event like COVID, and you have to be able to pull the trigger and know when to get out of it. And people end up marrying their investments and falling in love with the idea of all the potential or how much it's going to continue to run, or worse, people get in after it's already made the run because they hear about it from their friends and they think that run is going to continue. And that's where the damage sets in, because if you're not paying attention and you're not getting out and you're not understanding that valuations are getting stretched, you end up suffering the fate of the backside of that, where it drops like a rock, and you didn't get out in time to stop that from either losing all the money that you put in, or at least losing the profits that you made on the way up, right?
Yeah, terrible.
Yeah.
A third time this has happened. So, like you said, history will continue to repeat itself. It's just how long do you want to pay tuition? We saw investor sentiment run to a lot of the companies that investors thought would be beneficiaries of a Biden presidency. And, actually in 1 or 2 webinars ago, we analyzed this relatively closely, looking at, hey, between a Republican president and a Democratic president, which sectors really seem to thrive? And the conclusion was actually it's close to the opposite of what a lot of people think, and here and again we're proving the point. And so with when Biden took office, we thought there was going to be significant push for clean energy, and beneficiaries of that initiative would be all these electric vehicle companies. And so here we're highlighting 3 of those companies. And I mean, in the moment, in 2020, you would have thought these companies are all going to be the next Tesla. And so to think, had you poured in assets, especially assets that you're relying on for your long-term wealth generation, you can see where that would have brought us here as we sit 4 years later of a 97% loss, a 91% loss, an 89% loss. And so to me, again, the picture this paints is market euphoria continues to mislead investors, and they will continue to pay that tuition in the form of losing their assets if they keep following just market sentiment and letting that be their guide.
Yeah, lesson after lesson after lesson. I mean, the problem I see, and I always say, I've seen so many of these scenarios and so many different clients and their reaction to it that I can paint the picture of exactly what's going to happen. I've actually done it before where I've typed up an email to a client and said, this is what's going to happen over the next 8 months. And almost exactly what I typed into the email happened over the next 8 months. And he didn't believe me, and he does now, I'm sure. But what ends up happening is even the people that get in early, it goes up like 50%. And they're like, oh man, this thing it's really going to the moon. And then they put more money in. And then it goes up to 100%. Oh, this thing's never going to stop. This is the way of the future. And they put more money in. And then when it collapses the other side, they end up actually losing money. Whereas if they would have just been like, oh, I got in early, this is cool, and found a time period to get out, knowing that it was one of those speculative trades, they would have probably had a great result in it. But it's almost like the people that get in early still want to punish themselves by continuing to get in throughout the process and add to those positions, not realizing that there is a day of reckoning where you really, going back to what you said, the market eventually looks at it and says, based on today's valuation and based on the future potential for this company, this stock is way too expensive, and the money just starts coming out of it like crazy. And so knowing when to sell is important, but also not getting caught up in the hype on the way up is super important.
That's right. What we're going to look at here is what we're seeing today, right? So we just walked you through 3 points in history where we've seen something, the market sentiment leading investors or misleading investors. And so Chris was actually, the timing's impeccable on this particular company. I'll let you explain.
I was just at a meeting and somebody said to me, have you heard of this stock? Or have you heard of quantum computing? And I said, yeah, no, we're about to do a webinar and we're going to talk about it. And he said, yeah, I bought this stock, QUBT. And I'm like, oh my gosh, it's literally the one on our slide. So everybody's talking about it, right? It's a big theme. And again, understand when we talk about this stuff, we're not telling you not to invest in these companies. There's a couple of key points you want to make. Is number one is to not put your life savings in something that is highly speculative and as risky as these assets. Understand what they are and treat them with respect, and make it a certain percentage of your portfolio, 3, 5, maybe 10%, depending on how much of that money you're willing to risk in this type of investment, but treat it like it is. It's a risky investment. And understand the patterns that when you get these big giant runs in these stocks, that you have to be able to pull the trigger at some point and take your profits and walk away from the table, right? Go. I don't gamble very much. I don't like losing money, but come with me to Vegas and you're going to watch when I play craps. Eventually, some of that money goes back in my pocket. And there's still money on the table, but I'm always putting money back in my pocket to make sure I walk away with my original investment and hopefully some of those profits at the end of the day, and I don't just turn around and give it all back to the house. Same thing with investing in stocks, right? So this stock had a euphoric run up and then a euphoric run down. It's actually up like 51% today. So the craziness and the euphoria is not over. That's why we're trying to bring this to your attention. We're still in the midst of all of this. But what did you say it dropped? It dropped 60% from top to
60%. So this screen capture was taken in December of 2024. You'll see it was up year to date for 2024, up 2,000%. But since this screenshot was taken in late December, it is down 60% from this price.
Yeah, and understand when something goes up 2,000%. it sounds good, and then you're like, well, but then it only went down 60%. If it goes up 2,000% and then goes down 100%, you still have nothing. So even though the numbers are bigger, its percentage is playing with your mind. 60% is a large portion of that money being given back in that drop. And like I said, today it's bouncing back the other direction, but obviously you can see some of the euphoria starting to come out of it. It was basically the CEO of NVIDIA got on, basically said, we don't see quantum computing becoming a thing for another 10 to 15 years. There was another CEO, and I'm drawing a blank on who it was. I think it might have been Mark Zuckerberg, who just voiced a similar opinion of we're 10 to 15 years out on this. And so they're starting to say, hey, this isn't a reality anytime in the near future. And when you start looking at these stock prices and you realize that, hey, if we're not talking about these things really working or being profitable for 10 to 15 years from now, that stock is way overvalued, and the wind's going to come out of those sales eventually.
And so one of the things that I don't know that we touched on, one of the things that defines a speculative stock or just a stock that captures our attention like this is when there is no evidence to support the price that we're seeing of the stock. And so what we're highlighting on this slide, and we have yet to mention, is this is a company, quantum computing, ticker symbol QUBT. This is a company that is currently valued at $2.5 billion with a B. Their annual revenue over 2024 was $386,000. So the multiplier to get to that valuation is too big to calculate live. But what we like to say, what we are always looking at is what is the cash flow, what is the intrinsic value of this company, and does it support this $2.5 billion valuation?
Absolutely. I think we're going to talk about Bitcoin in a second, and it's one of the big problems I've always had with Bitcoin is that you give me a company, I can do a fundamental analysis on the company and tell you what is roughly its intrinsic value, what should the stock price be. I have some kind of a gauge of where it should be today, where fair value is, and where I see it going in the future based on future earnings growth and projections and whatever it may be. Bitcoin and some of these, it's so hard. Well, Bitcoin's impossible to put any kind of fundamental analysis together to tell you what a price of a Bitcoin should be. I mean, it's purely a speculative, demand issue of where it's driving the price, but you can't do any kind of real digging or computation to be able to tell you what that is actually worth. That's what we're saying with these companies. Again, it's not that these companies are bad, it's not that they don't have potential, but these ones, we actually do have some numbers, and when you look at the numbers, the valuation is just so stretched beyond the stratosphere that it just fundamentally doesn't make sense. And so you have to start to question, is there enough growth potential in the future to even come into the realm of being able to make this price make sense? And in most cases the answer is no, and that's where you start to say, hey, great, if I made money, cool, but there is a point where you're going to have to take some profits off the table and just understand that the valuation is just not there.
The last thing I want to highlight on this, because you should question everything that you read online, every analyst rating, every Morningstar rating, you should question what we say, is if you look at the analyst's opinion of this stock in this screenshot, it is a strong buy.
I saw that. I couldn't believe it when I saw that.
And so question everything before you place your hard-earned money and your wealth in positions like this.
Yeah.
Here we are, cryptocurrency. So we've touched on it enough. We won't go too far into detail. Bitcoin up 40% since Trump's victory. At one point, it had peaked over $100,000 per Bitcoin. And really, the reason for this craze is the public sees Trump's administration as favorable to cryptocurrencies, hopefully bringing in some regulation to where now it opens up the market and therefore more demand for Bitcoin and the several of the cryptocurrencies. And so that's why we're seeing that kind of pre-run up to, hey, this could be a widely spread asset class and I want to get in now because then the value is going to explode. Do we necessarily agree with that? I'll let Chris answer that. But
I mean, I don't want to make any enemies out there. I got a lot of friends that are real big fans of Bitcoin, and again, if you're making money in it and you're being smart about watching it and understanding when to get out and how to manage, by all means, go ahead and have fun with it. To me, it's just not the way that I invest, because I can't wrap my brain around what a Bitcoin is actually worth, because again, there's nothing that I can use to run a calculation to tell me that it's supposed to be worth $100,000 or $200,000 or whatever it may be. And the concern I always have is when you have guys like Jamie Dimon, who's the CEO of JP Morgan, coming out and saying that Bitcoin is the largest Ponzi scheme he's ever seen. And so when you have people that are saying those types of things, you just have to understand it's not that you shouldn't play the game. Maybe you shouldn't put your life savings into it, and if you are, then be very, very careful with what you're doing with it, and just understand that to treat it like it's anything other than a speculative asset class, it would be detrimental to your financial well-being moving forward, right? If you want to be a speculative investor and you want to put all your money into speculative assets, that's fine. Just understand that is what you're doing and that is where your money is, and treat it accordingly, right? But to pretend that this is not a speculative asset and not a risky asset is where I think it could be detrimental to your future. And that's where I see people that are saying like, oh, I'm just going to take my life savings and put it in there, and then they go back to work and ignore and not do their research on a regular basis. That's where you might get yourself into trouble, because it has turned the corner a couple of different times where it's dropped relatively quickly. My big fear is that it just disappears one day, honestly. But who knows? I don't know. I say this all the time. If anybody tells you they know, they're lying to you. So we don't really know what's going to end up happening. I just know that this is not where we're putting investor money, because we invest for the long term, and we like somewhat predictable rates of return for the future, so that we can project out where we want our clients to be in the future with regards to their financial plan, and to get them to their goals in the future. And this is highly unpredictable to me, and so it's just not a major asset class that we play in. But it does highlight the fact that it's just another very speculative asset class that has had a huge run in the very short term, which just again highlights the cycle that we're in, where we start to see this euphoria that takes place in those speculative assets, which unfortunately tends to turn into the next downturn in the market. And that's really what we're paying attention to as managers, is to say, hey, we're seeing the signs of a potential pullback here in the near future. What are we going to do about it? How are we going to make up for that and protect our clients?
Yeah. Man, I really think you can do this justice.
So it really, what it's showing is retail traders. And unfortunately, if you're a retail trader out there, hopefully you're good at it. I really hope you are. If you're not, then you're just like everybody else that they're talking about in this slide, which is the institutional money is typically getting in early and getting out early, and the retail traders are coming in late and getting out late. And so a lot of times they basically say once the institutional money has made its money, it's the retail money they're taking it from, the retail investor they're taking those profits away from, and the retail investor gets caught holding the bag. And so what this chart is showing you is the orange circles are, let's see, I'm trying to remember.
Yeah, that's where retail's entering the market.
Yeah, so retail enters on the red circles, and they're getting out of the market at the blue circles. So what ends up happening is euphoria sets in. Market rallies like crazy through 2020, and you start to see a large amount of retail investors jumping into the market at the tail end of that 2020 run coming out of COVID. Then all of a sudden the market pulls back, and the retail investor is like, I don't want any part of this anymore. And so the retail investor starts selling because the market is down. And then you see the market start to rally again through 2023. Retail investors start piling back into the market. Market falls through 2022. And then the retail investor starts getting back out of the market. And the problem with this, we see this over and over and over again, is that the retail investor they ignore the market when it's bad. it's not fun. They look at the TV and they're like, everybody's losing money. It isn't fun. I've been in this business for close to 30 years. When the market's down, it's not fun. I mean, I actually kind of like it now because I'm like, everything's on sale, right? So I get excited. I get to go buy good companies at a cheap price. So I like down markets to some degree, but it's not fun. People are losing money. My accounts are going down. We're all seeing values drop. But most investors, they just turn off their TV. They want no part of it anymore. It's just not fun. They don't want to look at their statements. They don't want to be an investor. They pull money out of the market. They want to move away from it. Exact opposite of what you're supposed to be doing. You're supposed to be running to that market. Go buy things at discounts, buy things on sale, put money into the market, get excited. And then when you get these euphoric runs, everybody's like, hey, have you heard about Bitcoin? You know, people want to buy Bitcoin now that it's up 40% in the last couple of months. And they're all excited because their friend told them about it, they see it on TV. And so the retail investor starts to pile into these assets after they've already had these big monstrous runs, only to flip and do it all over again. And the retail investor just gets hammered. They said something, I forget the exact statistic, but it's like the average mutual fund in the world has an average annual rate of return of somewhere in like the 8.5% range. And the average retail investor in those exact same mutual funds have done like 3.5. And it's because they're getting in and getting out at all the wrong times. They're moving against the grain constantly. And so we just want to continue to point out, like, we're watching this because we fight against that. When we see these euphoric runs, we're thinking take profits, pull money off the table. And when the market drops the next time, some of those profits we pulled off the table, we're looking to put those back into the market at lower prices before the next run comes. And I always say, if you can get on the right side of the trade and get in that groove, you become really good at investing. You start to make a lot of money versus the average retail investor that does just the opposite.
Two things. One, when you first told me this, that this was a signal for you, a market signal that you go off of, is when clients are calling you, telling you what to invest in, that it is always means we're at the 11th hour. And I'm like, I think people do their research. Maybe it's just things Chris hasn't heard of. But time and time again, 2021, you proved that right. And then sure enough, December of this last year, your phone was ringing. I hear you giving people advice of like, hey, I would be very careful with that, and it's not something that we're going to add to our stock portfolio, but you're welcome to take fund money and apply it to it. So, we'll see what the next few months holds. The point two, I want to give credit where credit is due, because going back to what you said about you're excited when the market pulls back, and there's blood in the market, as they say. Jennifer Brown, one of our advisors at Prosperitas Financial, I'm going to give you all the credit, Jennifer, because this is a great quote. You say, I want the market to be down for every day until the day I retire, right? So you should be hoping that market is red for however many years that you have left up until you retire. That's when you want to see an overvalued market.
Absolutely.
So.
Yeah, I've been telling people recently, it's like going to buy a car right now. You want to go buy it's kind of like when we were dealing with the COVID issues, right? Inventory was low, you went to buy a car, you go look at this $100,000 truck, right? And they're like, well, it's $120,000. There's a markup on it, right? You don't want to buy that truck, right?
That's right.
It's overvalued, right? Stocks are similar to that right now. We're looking at a lot of stocks, and I'm looking at the valuation, and I'm like, it's just not attractive. I don't want to buy that. But that $100 truck goes on sale, and they're now selling it for $80,000. You walk into that, and you're like, yeah, I want to buy that truck. Right. Stocks it's the exact same thing. Okay, when the market's down, those stocks are cheap. They're on. I get excited. I'm like, oh my gosh, it was NVIDIA in October of 2022. It was down 65%. I put my oldest daughter's entire college education fund in NVIDIA right around October of 2022, because I was like, who doesn't want to buy NVIDIA down 65%? This is amazing, right? Yeah. And it rallied like crazy, but I'm certainly taking money out of NVIDIA here because I'm looking at NVIDIA. I still love the company. I think the future is very bright for NVIDIA, but it's had a huge run and the valuations are stretched a little right now. So starting to get nervous, right? Once you get onto that side where you really see those opportunities and you see rallies and euphoria like this as a concern, that's when you start to get really good at this.
Is she the only student in a Bentley, or
No, but
more others did the same thing?
I'm not concerned about paying for college. Let's put it that way.
Yes. Well done. Well done. All right. The fun part. Again, I want to let you run with this, Chris. Chris leads our investment management team. Very happy to be part of that. We have a extensive team at Prosperitas, Eric Abrahamian, helping to put this data together, which has been incredibly invaluable. But as the leader of this initiative, I want you to take this and run with it, because it's been phenomenal.
Thank you. Yeah. I saw a post on Instagram the other day, and it said, Warren Buffett has beat the S&P 500. And I immediately sent it to Eric, and I said, where's our post? Because we have very competitive returns right there with, Warren Buffett, great investor. I love Warren Buffett. But I think we're right there with him. We could compete heavily with his returns over the last decade in some of our portfolios, specifically our stock portfolio. Our stock portfolio had another phenomenal year. It continues to, we benchmark it against the S&P 500. And as we told you earlier in the show, S&P 500 was up just over 25% in 2024. Stock portfolio was up 27.64. So what, 2.62% outperformance in the stock portfolio. Our tech and innovation portfolio, very volatile, crazy portfolio as far as the volatility in that portfolio, but one of our best performers. And it had a phenomenal year. We benchmarked that against the NASDAQ. NASDAQ was up 29.57, and our tech and innovation was up, 58.65 or something like that. It's pretty far from me. It's 58.65 or 85, something like that. But I would say that's destroying the index that we are benchmarked against. And then another one that I'd like to highlight is our capital preservation fixed income portfolio. I think is very important to highlight. That's our bond portfolio. So if you ever hear me mention, I tend to refer to it as the bond portfolio, but it's actually our capital preservation fixed income portfolio. No stocks in it. It's entirely a bond portfolio. And it was up 7.02% in 2024. And as we told you at the beginning of this, the aggregate bond index was up 1.25, I think it was. And again, with a horrible fourth quarter. And we did not have a horrible fourth quarter. We were down, 0.32. So again, I said it a moment ago, and I'll say it again. When you're a manager of money for a large number of clients, we have, 2,500 clients or something that are in our models in our portfolios, okay? When you're managing money for a large number of clients, what you're trying to provide is a somewhat consistent, somewhat predictable in an unpredictable world rate of return based on the different portfolio or model that you're in, because we're financial planners. To me, it's not about the money. It's about sending your kid to college. It's about retiring one day. It's about buying that vacation home you always dreamed of. It's about investing money in your first home. It's about buying a business or starting a business. It's all the goals and the dreams that you have for your future. And as financial planners, we try to help our clients understand what are their goals, what are they trying to accomplish, and how are they going to get there. And a lot of times that means putting money into investments that they know are going to give them a somewhat predictable rate of return over time, so that when they get to retirement or they get to college or they get to buying that first house or that vacation property, that money is going to be roughly what they estimated it would be at that time, so that they're able to achieve that goal. And so all of these portfolios are built for that. They're built for longevity. They're built for consistency. They're built to provide what that client is going to need, hopefully what you need over the long term, so that you're able to accomplish your goals. And that's why we have so many different versions of them, is because everybody has different needs, different requirements, different things that they're trying to accomplish. And so we try to have a portfolio that matches up appropriately to whatever your needs are, whatever your goals are, so that we can have you in the right portfolio based on what you're trying to accomplish in the future.
Well said. I don't have anything to add to that. That was excellent. What we're looking at here, to echo Chris's comments, are the stock portfolio's performance against its benchmark, which is the S&P 500, over the last 5 years. And so really you'll see year by year, it's always our goal to exceed or surpass the benchmark for any one of our portfolios that we're looking at. But it's not something that we can say, blindly, hey, we guarantee that we're going to outpace, right? Anyone that guarantees those results, that is likely also a Ponzi scheme or something just to run away from. So keep that in mind. So while it's always our goal, it's not something that we can guarantee. But what I love about this slide is showing the stock portfolio against the S&P 500, their relative performance, and you can see, again, 2024, we beat the benchmark by 2.62%. 2023, we beat the benchmark by 8.24%. 2022, we in a down market too. So this isn't just, hey, in euphoric markets we want to try and capture above. 2022 was that strong down market, a lot of tech sell-off, and we see our stock portfolio down 13.4%, the S&P 500 down 18%. And so a differential of 4.7% there. You can see in 2021, that wasn't a rock star year for the stock portfolio, right? It's not about guaranteeing or hitting grand slams every single year. But what we look at once we add 2020 as well, and we look at that 5-year annualized, when we can say the stock portfolio over just the last 5 years has, on average, outpaced the S&P 500 by an average of 4% per year, that is a significant margin. And that's what in the investment management world is called alpha. An alpha of 4 is incredible. The one thing that I love that Chris always repeats in our office is, investment management is just one piece of what we do as financial advisors. There's tax planning, there's the financial planning, there's estate planning, there's making sure and risk management, there's making sure all of these different pillars of a client's financial life is well organized. But we are only compensated on one transparent fee that is on every statement and every client can see, and that's anywhere from 1 to 2% depending on your specific situation. But when there's a stock portfolio that we're managing for clients, and on average, if we can outpace historically by 4%, it's like getting all of those services for free, right? And so almost, I hate to frame it this way, but it's almost like people are getting paid to be a client of Prosperitas, assuming they're in the stock portfolio, and makes the most sense.
Yep, I say it all the time. I really do. At the end of the day, that's what I want the client to feel like. Oh, gosh, they do this. Man, they're managing like all of my financial life. They're constantly there for me, giving me advice. They're on top of it. They're taking care, and my portfolio is outpacing net of fees, net of costs. It feels free at that point, right? It feels like, man, we have phenomenal performance. Our portfolios are doing better than we expected, and we're getting all this extra stuff. And that's another thing we pride ourselves on, right? We give so much above and beyond the investment management side of things to help people and guide them to their financial goals. That it does. That's what we want it to feel like, is that we want it to feel free. One thing I would highlight that kind of goes with all of this is a question I get a lot with new clients, and they say, hey, stock portfolio, it's aggressive, right? Yeah, I would consider it. It's an aggressive portfolio. It's 100% in the stock market, has big returns. Obviously, it's averaged, north of 14% over the last, 18.5% over the last 5 years. That's what I would consider an aggressive portfolio. What it's not is a word I've kept using throughout this. It's not speculative. So a lot of clients will say to me, I just don't want to lose all my money. We don't play in that world, and that is also why some of those stocks that we've been talking about throughout this don't excite us, because we're not in the market of investing money in a way where we're going to wake up and it's just going to be gone. We may have some down years like 2022, okay, but overall, the portfolio is built for longevity and built to last and built to get people where they want to go. And that's why we stay away from that speculative side of the trade. It's not that people shouldn't play with some speculative money if they want to. It's just not what we're going to do because we're not in the market of losing people's money.
Yep. Couldn't agree more. You, the listener, have patiently waited, and right now we will be dropping in our annual letter into the chat. You can go download it there. But to what Chris is saying, if you really want to look under the hood, if you want to see how the sausage is made, we include this in our annual letter. We've added 2 new positions in the fourth quarter of last year. A lot of what we talked about, we really do an in-depth analysis of what is the difference between an investment and a speculative holding. We're also going to touch on the business updates. So as for Prosperitas Financial as a firm, we're highlighting, the incredible CSAs that we added last year, new advisors that joined us last year, and so you can learn more about Prosperitas Financial and how we're managing our stock portfolio and kind of what our outlook is. So make sure you check that out. If you're watching this on a recording and not live, feel free to just send the words either in the subject or in the body of the email annual letter to our managed email of info@prosperitasfin.com, and we'll make sure to reply, send you our 2024 annual letter. You can check it out, no strings attached. With that, we just want to thank you for joining us. Our target is, believe it or not, always to stay concise on these and bring you immense value in under 30 minutes. I know we've gone significantly over, but hopefully there are a list of notes that you've been able to take away from this. You've been able to better understand, our investment strategy at Prosperitas Financial, the things that we're paying attention to. Hopefully that allows you to become a better investor yourself. And ultimately, if you're not already a client of Prosperitas Financial, we would love to have a conversation and see if there are areas that we can add value to you. So make sure to reach out to our team. You can use that info@prosperitasfin.com to get connected with one of our advisors. The last thing, Chris, do you have anything that you want to mention for prospective financial advisors?
Yeah, I would just say, for any of the financial advisors out there that are looking for a home, we want to bring in good financial advisors to expand our presence throughout the country, really. Part of the reasons, I say it a lot, part of the reasons that I started Prosperitas Financial is me as a financial advisor, I can only impact so many lives, right? There's only so many people that I can work with and meet with on a regular basis. But by forming Prosperitas and having more advisors within the firm, it allows me to somewhat have a bigger impact on a larger group of people through each of the advisors that work for the firm by being a part of the team and being able to help those advisors with their relationships with their clients. And so we're looking for not every advisor under the sun, but we are looking for good advisors that care about their clients, that want to do good work for their clients. If you are interested in hearing more about the firm, please reach out to us. This webinar and the portfolios that we manage is just one aspect of what we do for our advisors, but I think it's a big aspect. A lot of advisors are not very good at managing money, honestly, to be 100% blunt with you. And some that don't want to do it anymore. It's just too time consuming, and they feel like their time is better spent with their clients. And some are using third-party managers that charge an arm and a leg for those services. There's just a lot of reasons why the investment management piece is something that we take care of for our advisors, to free up their time, free up their energy, free up their mental space, and provide a good service to their clients that they know that they can rely on and keep their clients abreast of what's happening within the portfolios over time. But there's so much more. CSAs, support staff, tech and innovation, software, financial planning, different strategic partners that we work with. There's so much that I think Prosperitas brings to the table that if you have any interest in finding out more information, please reach out to us. We'd love to have a chat with you.
Yeah, completely agree. Thank you all for joining us. Have a great rest of your day.